A 4% yield, monthly payouts, nearly 1,000 holdings, and a projected 11% yield on cost. But is this ETF actually worth your money? Welcome back everyone, I'm the Swedish dividend investor. So we are going to take a look at a new ETF today. And it's not a covered call ETF. Some of you guys asked for it, and I do think it is a very interesting ETF. LDGL Global Quality Dividends UCITS ETF. Ticker LDGL or LDGG, depending on what exchange you buy it on. As always, this is not financial advice. I'm just sharing my investing journey, my experiences and my analysis. Read the full disclaimer in the description. Alright, we are going to go through what the fund is all about, holdings, sectors and country allocation. We won't be doing a performance check since it is so new, and I think checking 1 or 2 months back is kind of short-sighted. We will also take a look at the dividend and do a sort of projection, and finally a valuation. So the LDGL Global Quality Dividend ETF seeks to track the FTSE Developed All Cap Dividend Growth with Quality Index. The index tracks the performance of equities from developed countries worldwide. It selects constituents based on dividend growth and other fundamental criteria. The constituent stocks are equally weighted and filtered to ESG criteria. The fund size is around 81 million euros. And they have a total expense ratio of 0.29%. On the Legal and General site, they also write, the investment objective of the fund is to provide exposure to companies with higher than average dividend and quality characteristics in developed market countries. And some highlights from their fund snapshot. The investment strategy seeks to invest in companies distributing income consistently and with the potential to sustain their dividend payouts while screening out for stocks with fundamentally poor balance sheet, income statement and/or ESG characteristics. The fund's distributing share class aims to provide a stable monthly income by targeting a consistent per share distribution informed by the portfolio's forecast yield. So investors get paid monthly, something very unusual for dividend growth ETFs. They also have a focus on ESG, so if you're into that, that's great. I like that they screen for good quality companies using fundamental analysis. I checked their documents and they go over how they identify consistent dividend payers. They take a forward-looking approach using expectations. The companies need a positive dividend growth rate over the last 10 years, and they also monitor the trend and consistency of past dividend distributions. They look for dividend sustainability by excluding screened companies with negative return on equity and those that have a low quality ranking. They look within mid and small caps. They also look at the forward 12-month dividend yield and they exclude the 25th lowest percentile. And in the document they also show the dividend yield at the end of September 2025 was 3.7%. As for their holdings, they hold almost 1,000 companies, 959 as the last day of March in 2026 to be exact. I tried using justetf.com for this, but their top 10 looked a lot different and hasn't been updated since the end of February, and my broker showed the same holdings as the underlying index when I looked at LDGL. So their top 10 is Equinor, Repsol, Inpex, Woodside Energy, Total Energies, Suncor Energy, EOG Resources, Devon Energy, Coterra Energy and Norsk Hydro. Wow, 9 out of 10 are in energy. I wonder what happened to that ESG screening. I think they are in the top, since energy has had a massive run after the US-Iran situation. Sector allocation, and you have to excuse me, they are not listed in order, so I will go through them in the order of biggest to smallest. Financials at 31.5%, industrials at 20%, utilities at 9.5%, consumer discretionary 8.76%, energy 6.84%, consumer staples 6.72%, Basic materials 6.56, healthcare 3.87, telecommunications 3.16, and technology at 3.04. Alright, so I would say a pretty conservative ETF, except the high allocation into financials. They don't have a country allocation listed, so we have to check my broker, since they seem to be up to date. We got USA, Japan, United Kingdom, Canada, France, Germany, Switzerland, Australia, South Korea, and Italy. So, to summarize the ETF, LDGL Global Quality Dividends ETF is a monthly paying ETF with a yield in the range of 3.5 to 4% with a low total expense ratio of 0.29. It's very well diversified with almost 1,000 holdings. They focus on quality companies and they use an equal weight structure. They have a focus on companies with a positive ROE and a positive dividend growth trend over the last 10 years. It is skewed a bit towards the US, but mostly well diversified across the world. If you enjoyed the video so far, make sure to like, comment and subscribe. It helps the channel a lot. Thanks! So, what about their dividend? Well, they have paid dividends for 3 months, and each time it was $0.0353. I just took that times 12 and I also converted it to euro. So that comes out to an annual dividend of 0.366 euros, and that's what the yield is based on, currently sitting at 4%. We have no dividend history to speak of, but I decided to do some projections. Scrolling down, we can see my small projection, and we can get a 10-year yield on cost. If we were to lump sum and not to reinvest the dividend, a so-called simple yield on cost, we are going to start a bit conservative. So, with 3% dividend growth, the 10-year yield on cost could be around 5.53%. At a 5% growth rate, we could see 6.84%. With a 7% growth rate, we could see 8.42%. And finally, if it performs as the American SCHD, Schwab US Dividend Equity ETF, and they manage a 10-year CAGR of 10%, we could see a staggering 11.41% 10-year yield on cost. Wow. But remember, this is just some napkin math, guys. Still though, not bad. Now, let's do a valuation. Why do we do valuations? So we don't overpay for an investment. We want to be able to somewhat guesstimate what kind of return we could get over a 10-year period. We use a growth rate to project the dividend growth 10 years forward. A terminal multiple. This is what kind of yield investors give the investment 10 years forward. A high multiple means a low yield, so a higher price, and vice versa. We also use a discount rate. This is our required return, and it's used to discount the summed value back to today, and we get a present value. We use 3 scenarios: normal, best and worst case. Finally, we do a mixed valuation to get a fair price between all the scenarios. I've gone with a discount rate of 10% for all cases. So for the normal case, I've gone with a 5% growth. Remember, we're trying to use conservative numbers. Using 2 exuberant numbers will give us a higher present value. Terminal multiple of 25, so investors give it a 4% yield 10 years out. We get a present value of 8.33 euros. For the best case, I've gone with a growth of 7% and a terminal multiple of 30. So in this scenario, investors give it a yield of 3.33%. So a bit of a premium. We land at a present value of 10.93 euros. For the worst case, I've gone with a growth of 3%. Now, is this realistic? I would say yes. This could be a higher growth for some years, followed by a cut, then some higher growth. I think you guys get the point. Terminal multiple of 20, so a yield of 5%. So investors doesn't really like this one. We get a present value of 6.27 euros. Just looking at these scenarios, we can see the normal case isn't that far from today's price of 9.15 euros. Meaning, if they grow their dividend with more than 5% and investors still value it at a 4% yield 10 years out, we could see an annual return of 9 to 10%. Let's wrap it up with the mixed valuation. Here we use a probability factor. I've gone with a probability of 60% for normal case and 20% each for best and worst case. We land at a fair price of 8.44 euros or 7.6 euros with a 10% margin of safety. So, to conclude, it is pretty fairly valued if the growth numbers plays out, but we have nothing to go on. The growth could be 0% or 10%, but honestly, a growth between 3 and 7% isn't a stretch in my opinion. So I would say it's fairly valued for a 9 to 10% annual return. Now, what about me? I like it. I like the diversification, the screening process, fundamental analysis, and the fact that they pay monthly. I think this ETF will be a staple in many European dividend growth investors' portfolios. Will I buy it? Yes. Someday I might. Right now, that depends on the market. I am on a high yield crusade right now, and I am focused on reducing my holdings and concentrating my portfolio. I would, however, buy this hand over fist if we get a market correction and the yield gets pushed up to around 5.5 to 6%. This doesn't mean this is a bad ETF, just that my focus right now is on higher yielding assets. I hold one dividend growth ETF in my portfolio, Exact Nordic High Dividend Low Volatility ETF, but I only buy it when we get a significant dip, like Liberation Day last year, and I'm totally fine with that. It is a strategy that has worked well for me, and I think I will do the same with this one. But I want to know what you guys think. Have you hopped on the LNG train? Could you see it as a staple in your portfolio? Am I stupid for not getting in? Let me know in the comments. But guys, that's it for today. I will see you in the next one. Until then, stay smart, stay patient, and keep stacking those dividends. Ha det gött!